budget did throw up some interesting changes for the mutual fund space. Amongst them is the removal of the dividend distribution tax. Dividends will now be taxed at the hands of investors instead of the AMC. Also, TDS, or the tax deducted at source, is now applicable on dividends. So let's find out how all of these changes will impact your mutual fund portfolios and what are the changes that you should make to the existing funds that you have. Feroze Azeez, Deputy CEO of Anand Rathi Financial Services, joins in. Hi Feroze, good afternoon. Let's talk about this, the dividend bit first, which is now taxable at the hands of investors, because there is, there was some confusion regarding that. One, of course, is that, who is it beneficial for? Is there anyone at all who should still be opting for the dividend option? And secondly, what happens to the schemes where you've chosen dividend reinvestment plans?
Great. I think there are two big important points to be noted here. One is it is beneficial to a larger audience because a large portion of the investors are below the 7.5 lakh, 10 lakh tax category, Sumaira. So if you look at in equity, for every person who is earning or whose income is less than 7.5 lakhs, this move will bring down the tax liability on dividends. Point one. Point two, on the debt side, up to 15 lakhs, if your salaries are up to 15 lakhs or your total income which you're paying tax for is up to 15 lakhs, you will still benefit of the you will benefit from the fact that dividend distribution tax has been abolished. So these are the two important benchmarks beyond which anybody below 15 lakhs of total income should choose a dividend option on the debt side, and he or she will still do better. And if you are at less than 7.5 lakhs salary bracket, equity will be better, dividend distribution tax. So you can choose a dividend option as long as these thresholds, you're within these two thresholds.
So are you saying that for those with dividend income up to 5 lakh rupees should opt for these dividend options?
So sorry, Mangalam, I'll correct myself and be more elaborate. The first step is, should I choose a dividend option or a growth option?
Right.
I have to first try and figure out what is my total income in that particular financial year. If my total income is greater than 15 lakhs, then you're better off in the growth option in the debt category. So this is not the dividend income, this is the total income which I'm referring to. So it implies that if my salaries or my total income is greater than 15 lakhs, choose growth options in the debt side. Okay, and on the equity side, the break even is lower because the dividend distribution tax is lower, was lower. So if I have a salary or a total income greater than 7.5 lakhs, then choosing a growth option on the equity would be better, assuming mutual funds continue to give the same dividends. What is in the interaction in the last 1 week with a few fund managers and asset management company representatives, quite a few asset management companies might reduce their dividend payouts and compel people to stay in growth or in dividend and make it neutral. So assuming the same dividends continue, you have to look at your total income.
Okay, in fact, there was a very interesting calculation that your team had sent out to us also, regarding this, whether you choose the growth option or the dividend option, which says that, between DDT and LTCG, it's better to pay the long-term capital gains tax, right, over the dividend tax.
Correct. So over the dividend tax, if I took some examples, if I have a dividend of 100 rupees, then in the 1 year category, 1 year return, let's assume it's 15%. On the dividend option, I was, if the 15 rupees is my 1 year return, 5 rupees was coming in the form of dividend and 10 was coming to me. I was paying a 10% dividend distribution tax. So what used to happen was, if there is a 10 rupee dividend, if there's a 100 rupee dividend, I'm paying 10 rupees as dividend distribution tax, and I'm left with including cess and stuff, I'll be left with 85 rupees. Okay, but if I now, the dividends are taxed in my hands. So if I am below 7.5 lakhs total income, this will automatically have a benefit of 3 rupees to 3 rupees 50 paisa. That's the net benefit out of dividend distribution tax not being taxed at the fund house level, but at my hands level, and I filing it for taxes at the end of the year.
But in any case, everybody should have been opting for growth, right? And what happens to those with dividend reinvestment as their option?
See, dividend reinvestment is completely obsolete because you're not even getting an inflow.
Yep.
All right.
But you're paying tax.
You're paying tax on your marginal tax rate.
Absolutely.
So dividend reinvestment is obsolete. Dividend is good for lower salary brackets. Out of the total 5-6 crore returns which get filed, almost 3 crore people fall in the category below 15 lakhs or more. All right. So it's very good for a large part of the audience because your dividend distribution tax in debt funds was as much as 25%. Now it can be as little as 0 if you're in the less than 5 lakh category. So this is a big lottery, especially for retired people. Why? Because your other sources, incomes of other sources is going to be lower. You definitely need a regular income. So it's a double benefit because you have no income or low income, and you also need regular income from dividends. So they become far more tax efficient.
And what about the impact of TDS on the mutual fund dividends?
See, TDS, of course, is something which you can claim back. It's only a logistical nightmare, if you want to call it
Absolutely.
that way. But that is something which gets deducted, but you get a credit from it. So it's just a cash flow which gets deferred. So you can get back that. And I'm sure income tax of late has been very prompt in returning the monies, which have been debited more than you deserve to. But I think on the dividend distribution tax being abolished, there's one very good news for all investors across growth, dividend and dividend reinvestment, which is a benefit of 30 to 40 bips, which is 0.3%, 0.54% on all schemes. Why? Because when you're buying a stock as an individual, if I as an individual bought a stock and if the stock gave me 2% as the dividend every year, I'm going to pay dividend distribution, I'm going to pay tax on it. But a mutual fund is a tax-free platform, so every mutual fund will now have an extra benefit of 0.3 to 0.5%, which is as good as the expense ratios of some direct schemes. So that's a good benefit because mutual funds will not pay tax either on the hands of them on their platform, or the company will not pay. So that's a revenue loss to the government. But that's one additional benefit to all mutual fund investors.
We're discussing mutual funds and the impact of the budget on mutual fund investors. We have Feroze with us. Feroze, you were talking about the dividend distribution tax and its implication on investors. How many people will it really benefit? Or are there people it will benefit?
Yes, I think it will benefit a larger portion of the audience.
Oh, okay.
It'll immensely benefit because of both the reasons which I mentioned. Firstly, if you look at how many income tax payers do we have have about 5 crore 52 lakhs as of FY18. Okay. Out of this 5 crore 52 lakhs, 5 crore of them are less than the 10 lakh bracket.
Okay.
For which both on the debt and the equity side, this will actually mean a lesser tax burden. So it's like 90% of the audience is benefiting. Okay. And in the debt side, if you look at on the debt side, you have almost only about 14 to 15 lakhs greater than the threshold. So out of 5 crore 52 in the equity side, 5 crore benefit. On the debt side, almost 5 crore 30 lakh people benefit. Now, unfortunately, all these are not mutual fund investors. They will turn into mutual fund investors because the highest probability of getting the next 1 crore mutual fund investors for the mutual fund industry remains here. Right. Out of the 2.5 crore mutual fund investors, I would assume that the same proportion would work. And one other benefit, which is the mutual fund having a tax-free platform. If let's assume a company X declares now a dividend, which is going to be taxable in the hands of the recipient, and if the recipient is a mutual fund and it does not have to pay the tax, so tax didn't get paid either by the company nor by the mutual fund. And if the mutual fund is in a growth option, so every investor gets benefited on this point too, but a significant portion of people get benefited with the 0.1. So I think it's a very good thing to make mutual funds more attractive in the long run.
But what about those who don't benefit? What should they do?
Those who don't benefit are those group of people, especially in the HNI category, high net worth category, or in salary brackets greater than 15-20 lakhs. Okay. There is a clear solution. And you can still come back to parity with what it used to be. So how do you do that? If you want any recurring cash flow, like people used to go into balance funds to get a dividend on a monthly basis. And if you're an HNI incidentally, or a person who's earning more, you please have to move from the current setup of anticipating dividends to an action-oriented systematic withdrawal plan. If you use systematic withdrawal plans, you will be as efficient as you were before and in the past, in the future as well, for two reasons. One, because systematic withdrawal plans at the end can give you an indexation benefit in debt schemes. And when you remove money in the form of systematic withdrawal plan, there is a capital portion and there is a return portion. The tax is only on the return component, unlike in dividend, because the tax is on the entire component. So getting a 50,000 systematic withdrawal plan is dramatically different than getting a 50,000 dividend. So please move to systematic withdrawal plans would be my key message to people who are in the higher tax brackets.
Okay, and finally, a lot of people in the last 1 year have had their units, mutual fund units, segregated, right, put in the side pocket. Now over here, finally the clarification has come that there's only short-term capital gains which will be applicable. So how should these people, look at these changes? How will they be impacted?
Correct. Firstly, if there's something which has got side pocketed, I am very hopeful that there will be recovery. That's when tax comes into picture. If there are some good papers which have been side pocketed and the fund manager is able to recover a reasonable portion, this budget made a very, very fair statement saying that the side pocket might have got created 3 months before, for example, but if you've invested 4 years, you've invested in that same fund 4 years back, the date of purchase of this side pocket will not be 3 months back, but it will be 4 years back. So you will actually be taxed assuming that you invested in the side pocket back then.
Yeah. Long term, sorry, not short term. I made a mistake. Yeah.
All right, so that's about the mutual funds and how they would impact you post the budget. Thank you so much, Feroze, for stopping by and helping all our viewers with that. But